So we're back to do another video discussing the 50-year mortgage, but going a little bit more in depth with it because the first one was a pretty good overview, but there's still some questions and I wanted to make a bigger, more comprehensive video, but for some reason, when I make a really long video, people don't watch them. So this is gonna be your part two, hopefully filling in some gaps and going into a deeper depth of conversation with it and possibly giving you a few alternatives. I got 3 options I think might help out most people. So let's hop into it. Hi, I'm Jake Tysiak, and we're going to be covering this a little bit more in depth because there was some comments on my last video that says, hey, you know, the payment's still lower. Wouldn't that still be a good option for most home buyers who can't afford a 30-year mortgage? So I'm going to cover it a little bit more today. If you haven't watched that first video, I'm going to have it linked down below. Please go watch that first. It gives you some good insight, and then come back and follow up with this video. One of the big comments that came from that one was like, hey, a lower payment is a lower payment. And for some people to get out of renting, it could be a very good option. And it does come with a little bit of caveat still, because as a realtor who gets paid on selling people homes, it doesn't always make sense for everyone to purchase. And what I mean by that is you really have to be secure and know that you're going to be in one spot for a long period of time. Even if you're purchasing a normal home with a 30-year mortgage, you really want to be there at least 5 years to make it worth it. And in today's economy, a lot of people change jobs and move around. So if you are in a situation where you think you might be moving in a few years, then it changes up the game plan just a little bit. And that definitely is escalated when you are looking at a 50-year mortgage, because as we mentioned, it takes so long to pay down your mortgage that really what you're looking at is hoping for appreciation on that property. Now, when you purchase a home, it is an investment, but I don't want you to think of it that way, and I don't want you to have to bet on appreciation, because that's where you can get into trouble if you do need to sell in the next couple of years or a few years down the road, because it's not inexpensive to sell a home in the market. So you're really banking a lot on appreciation. So much that the 50-year mortgage actually sort of resembles an interest-only loan. And we did see these types of loans. They were popular with investors in the 2000s, where they were banking on that heavy appreciation going on and on and on, and then making a bunch of money without having to put a lot. But as we showed, there's a lot of interest, even with a normal mortgage that would be a 30 or 50-year mortgage. So that's definitely something to consider. As you can see, now you're taking on a little bit more risk, hoping that the market continues to go up and up and up. And that's really what brings me to my next point. Now, in our first video, we were assuming both that the 30-year and the 50-year were the same interest rate. We were looking at a 6.5% interest rate. And here's the thing, that's not the case. Because the longer that you have that loan outstanding, there's a better chance that you default on the loan and that you are more risk to that bank. So what a bank's going to do is charge you a higher interest rate. And that is the similar principle when you go from a 30 to a 15-year. You're going to get a much better interest rate in today's market with a 15-year over a 30-year. So normally that is over 0.75%. Currently a 15-year mortgage was looking at about 0.875% lower than a traditional 30-year. Now, obviously, we don't know what a 50-year mortgage rate would look like, but if we can make an assumption that that's going to be 0.75% higher than a 30-year mortgage, now that really changes our payment plan. Originally, with our 30-year mortgage, we were looking at $2,022 a month payment. With that different interest rate on a 50-year mortgage, now you're bumping that payment way up, $1,987. So now we're only looking at a difference of really about $35. That is not a lot of money when you compare the two. And again, because of the length of the loan, our interest is going to go up as well. So now instead of paying $408,000 of interest on that loan, you're up to $872,000. So significant amount more that you're paying over a longer period of time with more restrictions placed on you. And that's why I think, honestly, the 50-year mortgage is cost prohibitive just from that standpoint that it's so close. There's so much more risk and downside if you were to go with that. Now, I obviously don't know all the terms. Maybe it would be a government-backed program with the rates being lower. We'll see if it comes to fruition or if it ever sees any kind of backing to it. But I did want to at least offer you a couple ideas or some food for thought on maybe some alternatives that could help you get into a home with a little bit lower down payment. Now, they're not going to be perfect, but stick with me because these might help you out. Now, my first tip is to actually give some consideration to what town you actually want to move into. You see, when we've been looking at, it's been principal and interest with all of our examples, but your taxes and insurance are also going to be included into your monthly payment with most mortgages. And that's what most banks are going to be banking their decision off of, is that total payment with everything. And we can do a lot more work if we focus on those taxes. So in DuPage County, our average tax bracket throughout the county is 2.16%, but it's not the same in every single town. So if you were to focus on areas such as Willowbrook and Downers Grove, you can see interest rates a decent amount lower than that 2.16%. Towns such as Oak Brook are only 1.33%. But compare that with towns like West Chicago and Glendale Heights, and you can start to see those get around 2.5%. So by having some flexibility in what town you're looking to move at, you can maybe offset that $35+ as that can add up a lot. Now, your second option is you can also ask for a little bit of help. Now, this can come in the form of a couple different ways. You can reach out to family members to see if they can maybe help with an additional down payment to offset and lower that payment in your purchase price. Or there's also still grants and programs out there available from the state that can be used for you, whether it is a straight up grant that allows you to not have to pay the money back, or an interest only loan that will help offset that, and that isn't payable until you sell the home down in the future. Now, both these options can help you lower your actual loan amount and keeping that payment intact, because what most people don't realize is that the banks are really making that their financial decision off of your payment and how much you can afford month to month. Either of these ways can help lower your actual loan amount and make you purchase a home at a much better rate with a 30-year compared to that 50-year. Now, keep in mind, these grant programs are always changing. New programs are coming into fruition as others are expiring, but I'll leave a link down below and I'd be happy to discuss any of them with you if you'd like. And my third tip is simply just to look for a home that costs a little bit less money. When we were looking between the two, initially we were looking at a 10% difference, but as you can see with the difference between a traditional 30 and the 50-year with the higher interest rate, it's not much. It's probably only a couple percent difference in your purchase price. So that might mean a little bit less desirable house than you were initially planning on. However, I still think that the financial benefit from purchasing that house, and then over time, you can improve it as you like, is a much, much better choice than putting yourself underneath that additional financial strain from an extra 20 years of payments. This still gives you the option to find a great home, find a place that you're going to love, and be able to spend some quality time there throughout your years and make a smart financial decision as well. So I hope this helps understand why I just still don't think a 50-year mortgage is a good idea and probably not even really feasible. But if you do have questions about the home buying process, give me a call. I would love to help you out on your next home purchase. I'm Jake Tysiak, Keller. We'll see you in the next one.